Ladies and gentlemen, good morning. Let me begin by saying it's an absolute pleasure to be here. And I'll be sticking to the script and speaking about building financial networks conducive to special projects. So we'll take it from two angles. The first one being, what is a financial network? We'll have another slide. So pretty much, I think it may be a bit misleading to say building a financial network because we have one in Jamaica that exists. When we think about it, it's comprised of users of financial services, service providers, and the means through which they are accessed. You have So we have, let's go to the slide that outlines. Forgive me. Okay, so we see a definition right there, and we would set the JSE as an example because the JSE is comprised of the platform itself, users, investors, brokerage houses, and the list goes on. Other examples, we would say are commercial banks, brokerage houses, BOJ, clients. Now, a network exists. I'm sure all of us here would have credit cards, loans, and would have accessed other things through the various networks and entities. However, it's clear to me from looking at it that there are strengths and weaknesses within the network that we find ourselves in. And it will make more sense when we look at what a special project is, which I've chosen to define as transactions such as divestments, mergers and acquisitions. I say IPOs, but I think we've seen a lot of IPOs recently, so that may not be as popular a concept or as novel a concept in the grand scheme of things because we have so many happening now. So the strength within our commercial banking, as I said, all of us have accessed these services before. However, there is an area that's neglected. And as you see right there, it speaks to the startup culture, angel investor network, private equity, and venture capital, which is interesting given that Jermaine just spoke to the venture capital pitch room, because I'm of the firm opinion that small businesses, and if you listen to any small business interview, you will hear persons speaking about issues with accessing capital. Interest rates are too high. And I think it's all reasonable. However, something I believe that's been neglected in the public discourse is that there's a disconnect or a mismatching of the risk profiles and the issuers of capital within the current financial network, and that in and of itself presents a weakness or represents a weakness or something that can be addressed. So rather than saying to a commercial bank to lower the interest rates, which may or may not get somebody in trouble, to my mind, I believe a better argument or a better thing to consider would be to say, how do we get more persons offering patient capital in our financial networks to strengthen it so that we are able to have more companies accessing capital at rates that will allow them to grow without providing an impediment to growth? Because we have seen it in the local context already where prohibitively high interest rates have caused, one, the rise of the whole trading phenomenon, which means this: you import a product, you sell it quickly, you turn it over so you can meet your 1% or 2% a month repayment rate, right? But that puts it at odds with a manufacturer who may need 2 years to start to turn a positive cash flow. I'll give you an example. When I spoke last year, I mentioned that Peter Thiel was an initial investor in Facebook. He had put $500,000 in 2005. Now, I think last year I may have said that 500,000 became 1.2 million in 8 years. It actually became 1.2 billion in 8 years, US dollars. So this person became a billionaire through an early investment in Facebook that was not turning any returns at the time. In fact, you were trying to access Facebook as a user, you would have to have a USA college domain to access it, nothing like now. And persons here who are attending school in the US can attest to that. In fact, it was limited to only a specific area, so it may have started with 10 schools and expanded thereafter. Facebook had a loan at 20% per annum and at $500,000, I don't think any of us would be on social media today because there'd be no Facebook. So that mismatching is a systemic weakness that I believe should be addressed if we really want to strengthen our financial network to grow and cause special projects to thrive. I will move forward. So I spoke to the client composition previously and the users. Now the ultimate irony in all of this is that in building this network, we're actually going from the finish line to the start because we have the exit mechanism right now in the junior market. There are countless examples of companies whose seed investors have exited their initial investment through the junior market. One such example would be Mayberry, who, when they had made a seed investment in Access or an early stage investment in Access of 38 million, I don't remember the exact date, but that 38 million became, well, close to $1 billion in under 10 years. Now, had Access been burdened with having to pay 15-20%, which was the going rate at the time, one would ask, would they get Access today? So we see the gap. I hope that's made a connection in our minds that augmenting or strengthening VCs and the angel environment and encouraging them will strengthen our network and, to my mind, reduce the pressure on small businesses from the standpoint of access to capital, and will also cause more small businesses to come into existence because the likelihood of being burdened with a repayment will be lower. So let's look at special projects. As I had mentioned before, I have chosen to describe them for the purpose of this discussion as deals of all kinds. The only one on this list that we would have seen with any measure of regularity would be IPOs, which I think we can all agree on. However, we are only scratching the surface of what can be achieved in this space if we get this done properly. Utensils, the table is set. That's essentially what that illustration is supposed to mean. You know, Chris Perry says on Facebook, he says green shoots all the time. So here's a few things we're seeing happening in the local context of our economy. Now, again, it's important to note that despite FinSAC and the financial challenges of the 90s and 2000s, early 2000s, through the stock exchange, we still saw a minimum, by my estimation, and the deals I can recall, of $2 billion of M&A activity, merger and acquisition activity through the Jamaica Stock Exchange. I don't know if many were aware of that. When RedStrike was bought for $750 million US, that was the whole foreign direct investment flow for 2015. It was literally almost the same number, $750 million in a nation of 2.8 million people. So it says that we are onto something here. But how do we replicate this? To my mind, there are a few things we need to do for special projects to flourish and really deliver economic growth, but also a strong pipeline of deals through the Jamaica Stock Exchange. And I'll name a few. Strong regulation. In recent times, we have seen some transactions that, to my mind, were good, but I think with an increase in volume, we're going to require rather strong regulation, because if you have a deal flow of 10 now and it's multiplied by 5, you have 50. A lot of pressure is going to come on the regulators to, one, approve, and two, to do so in a timely manner. An expedient transaction cycle, meaning from conception to approval to execution. Ease of entry, as I alluded to, a lot of that $2 billion of deals was actually overseas capital. Heineken, I believe, is a Dutch company. When Renegade was bought out, it was initially bought out by Angostura, and then Campari, that's Italian. And there are countless others. Dalton Discovery, that bought the majority stake in Dalton Coast from Mexico. So I don't believe ease of entry is a major challenge. However, it's not something one can neglect. The larger angel and VC populace will help to create a flow of special projects locally. There's no question about it. And if there's one thing I would want recalled from this brief presentation, is the need I can appreciate that we will look at interest rates over time as the market dictates. However, it's not just supposed to be an interest rate environment anymore, because low interest rates have resulted in a flood of liquidity in the markets. And the story is told when you see $19 billion raised by Wisynco in a matter of weeks, despite the fact that it was relatively short notice and it was close to Christmas. So, lastly,